Hello, everybody, and welcome back to a new episode with us at IHT. This is something that I've been wanting to do for a while. Obviously, I've not made a video for a while. Got sick and tired with the legal accusations from you know who. But today, I really want to talk about this because a lot of people talk to me about creating strategies with TradingView, but it looks golden. You know, it wins. 60% of the time, it wins every time. And but the problem is that when they bring it into real life, it's dog shit. Yeah, and that there is a lot of things you need to understand when you do this. So there's websites out there where you can see people with their strategies. They have there's one that I always used to watch. I can't remember its name now, but maybe I'll put it in description if I remember. Basically it just goes through loads of strategies. So you have loads and loads of strategies on TradingView, and he tests it and he goes, there you go, that one was really successful, it did X, Y, and Z. Bullshit. It might have worked in TradingView using the TradingView setup, but in real life they do not fucking work. Believe me, they do not fucking work. So what I want to do today is just touch on it's gonna be a short video, but just a couple of things that I always tell people to watch out for. Now, the first thing when building a strategy is that you need an idea of what your risk to reward is. Now, this is fine, right? Risking 50%, or 50 points, whatever those points may be worth to you, risking 50 to make one, because your win rate is going to be a lot higher than if you're risking one to make 50, right? And that's obvious because you've got a lot more to go to win. Whereas if you can get triggered in and you can win really quickly, why not, right? If you can get in and out and make that skim, go for it. And here you can see that actually doing this, you need to win 98% of the time, right? Which is a high win rate. But because you're just like asking for such a tiny amount compared with what you're risking, actually these strategies are tending to be the better options for a lot of people. But anyway, that's by the by, that's not what this is about. But if we look in the middle side of it, risk one, make one, it says your break-even rate is 50%. Actually, it's not, right? It's more like your risk, in order to break even at 50%, you need to be rewarding yourself probably about 1.3 or even 1.4, depending on a couple of factors we'll talk about in a minute. And this is why this sort of side of things in TradingView, when you're doing your TradingView strategies, and we'll go into TradingView and have a look at a couple of things, this is why it just never works, because you don't have to win 50% of the time then. You more likely have to win 60% of the time in order to get a break even. And this is what is the leading drive here. Now some might be thinking already, like, what the fuck is he going on about? But I'm gonna just try and sort of explain that here. Now, when considering your strategy, right, whether it's in TradingView or not, you have this is your Achilles heel as a retail trader. So people who aren't doing this professionally, sort of employed to do it, working for a VC or a big investor, whatever, capitalist. If you're not doing that, then you're a retail trader. And this is your Achilles heel, because you do not buy directly from the market, you buy through a broker. And what that broker offers you is that broker offers you two things that really shafts you in the backside, and that is slippage and commissions. So all the lots or shares that you take out, whether you win or whether you lose that trade, you pay commission. Win or lose, you pay commission. Period. Right? And the slippage is the difference on a trade between the buy price and the sell price. okay? If it always matched, then price would go nowhere and there would never be any ups and downs, right? Because it always matches. Whereas what the slippage tells us is that someone wants to buy at X and the seller says, no, I want to sell at Y. And neither of those actually happen until somebody else comes in and says, and he looks at both prices and they say, oh no, I want to take that one. And then they take the whichever one they want to go with. If it's a buy, they go for the lower one. If it's a sell, they go for the higher one, whatever, right? So the point here is that there's never an alignment between the buy and the sell, right? It's always a gap between it, which is what is called slippage. And these are two very, 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 I'm saying very quite a lot, very, 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 very important things when building a strategy. You know, TradingView or not, this is massive. And going back to our risk to reward calculator, this is why if you trade 10 times and you win 5 and lose 5, you're going to be down an awful lot of money. You are going to be out of pocket an awful lot of money. Why? Because on every single 10 of those trades, every single one of those 10 trades, you will pay commission on, period. Whether you win or lose, you pay commission on the losers, you can pay commission on the winners, right? So that's straight away money gone. And your slippage is what we're going to talk about now, because this is really, really, really important. Okay, so we're going to jump over to TradingView. When we're looking at TradingView, and we can choose any pair, here I'm looking at GBP Swissy. It can be anything. I'm not going to do anything here. I'm just going to use it as the example. If you are looking at this, you have to choose a broker in TradingView to view the price, right? So I've chosen FXCM, which is quite common, and that's the price there, right? So this is where we are now. In that price, there is a difference, okay? Behind this candle, behind this moment here, there's a difference. Here, TradingView calls it spread. I've called it slippage. I put it in the same category as the horrible words out there like sticky and discharge. Like it's just, it's that category. But anyway, spread, slippage, whatever. It's the difference between the buy and sell. Okay, that's sort of layman's terms, right? And here is where we start to see this being significant. Because if I pull a strategy here based on this, what I'm looking at right now on screen, I'm using FXCM. So if I go off now and I place a trade with, let's say, FTMO, I'm doing an FTMO challenge, which we all want to be doing. We all want to be billionaires. So I put it in FTMO, but this is not FTMO. This is FXCM broker. So if I go into a split screen here, let's do that way. And I go to, so I've got GBP Swissy in this one. Let's go to GBP Swissy in this one. And I'm going to go to Oanda, is that how you say it? Oanda, Yolanda, Oanda, something like this. So anyway, you can see that the pricing's a little bit, like even the candle setup, you can see variations in what it is. Some are a little bit more, bigger, some are a little bit more narrower, this one, etc. I know it's all to do with the zoom and stuff, but whatever. The point is, look at the price difference. 08203, 08217. They're completely different prices. Completely different prices. Now, let's go and find the broker for FTMO, right? And you do this by, I believe it's colon FTMO. Well, there's the what is that? That's like their trade. I don't really know what the fuck that is. The point is, right? that fucked me up. But the point is, if we go back to GBP Swissy, the point is that there is no broker in this list, forex.com, capital.com, Pepperstone, ICM, Saks, ICE. Where's FTMO? I can tell you where it is, not in this fucking list. So the point is that whatever one you choose, let's try Pepperstone, very popular one. Look at the price. Fucking completely different. Same pair, different broker. So when we look at that here, and I've, let's say we got a strategy here and we go, whoa, look, I'm going to fucking say I'm using, let's go back to one screen, not to confuse the issue. So let's go back to this one. And I think, wow, like, I've got this, there's sort of a pullback here and then a push. And I think, right, okay, let's have a look where the equity could be. Right, okay, you know what? I'm going to put a trade here, right on the low of this, maybe there in the gap there. And that's my trade, right? And look, TradingView comes down, it taps that line, bomb, I'm in, off you go. I could put this in FTMO and never get tagged in, ever, ever. Because the prices are different. So by coming up with these strategies, you have to do the strategy with a huge amount of wiggle room. You can't be thinking like all these fucking twats out there that are gurus and whatever that are telling you like, oh look, I did like 1 pip stop loss and it tagged me in and I got like 50 gain return on investment, man. Like what the fuck? Shut the fuck up, will you? Like what the fuck are they on about? I don't know what how these people get away with it, but they're just bullshitting you. You cannot build a strategy in TradingView and expect it to work in the real world unless you are using the exact broker that you're trading in, which means that you're self-funded, right? Which majority of us aren't, right? And we will never be, really. Not only because trading is so fucking hard, but it's because of things that I'm talking about now. And even with the right broker here, let's say you have an account with FXCM and you're self-funded, you're still going to be paying commissions on every single trade. And like one lot might be like, $4 or $7. But if you're trading 40, that's a lot of commission out of your profits. So, and if we remember, if we go back to our our risk reward, you cannot be as blasé and go, oh, I need to win half the time and I break even anyway, so it doesn't really matter. No. You don't. There is no break even as in 50-50. There is no 50-50 in trading. None at all. So, like I say, if you're building strategies and you're doing X, Y, and Z, a lot of people do like EMA bounces, so like crossover of EMA, a pullback to touch, that type of thing. All of this data is based off of this broker. So you might get crosses where crosses don't happen on your broker. Or if you're looking at funded accounts, FTMO or whatever, I use FTMO because obviously everybody knows FTMO. But do you see my point? You cannot rely on what you're using here unless it's the actual broker. FTMO, I've Googled it, Googled the shit out of it. You will not find a broker that is the same prices as you get on FTMO. You just won't do it because they have their own shit going on, right? For what they're doing. You will not be able to get anything that's similar. And one might be similar, like you might find that Euro GBP is similar. Oh yeah, look, it's a similar price, but tomorrow it'll be completely fucking different. So you cannot rely on it at all. Okay? Okay. So let's go to the next thing, right? So the next thing I want to do is I want to show you this as an example, right? So I have a where is it? Let me see. There we go. So I have an account here. This is a demo account, Don't worry about sort of any of this shit. It's just a demo account. And I just want to show you what's going on here in this demo account. So I've traded a lot here, as you can see on this one, on GBP JPY. And as you can see, okay, as you can see, look at my winnings, $284. Actually, I'm paying $100 in commissions because of the volume I'm trading. So I only actually realize $149. Sorry, $179, can't read. And look at the inconsistency at some of the trades, right? So let's go down. Let's go down to these two here, right? And I know it's only marginal. It's not that one. Yeah. So here, look, right? Look at that trade there. Same amount of lots, okay? Or the volume, same volume. Same commission on that volume, but look at the closed profit and P&L. I do exactly the same pip target on every single trade I do. But why is it different? Why is it different? And this is something I want to draw light. So there's your commission buzz, right? So, you're fucked. Commission, that's a lot of money going out of commission, right? When you trade. Yeah, so there's a lot of things I'm showing you here in this window. But the point is, this is not good. It's bad news. It's like, it's not bad news. It's like, yeah, I don't mean to say it's bad news. It's something that you need to accept in life, right? When you're trading, you have to pay commissions on whether you win or whether you lose, you are paying commissions. So the point is that your winnings are a lot lower than what you expect, which means that's where your ratio comes in. So there is no win one, lose one, oh, I've broken even. No. If you're risking 1,000, like here, let's say I'm risking $1,000 to make $284, right? So it's like my ratio is like, what would that be? That would be 1 to 4, right? So, or 4 to 1, right? So at 4 to 1, my break even is I need to win more than like 75%, right, on the book. But no, actually it's not. I need to win a lot more. I need to win probably like 85% of the time in order to facilitate and cover the commissions I'm losing. I know it's a little bit sort of techie and complex here, but hopefully you see the point, right? This is something that people don't think about when they're building these strategies, and they think, oh yeah, look at this, it's fucking great, but why aren't I up as much as I think I am? Well, you're not up as much as you think you are because it's fucking bullshit. Yeah, you're missing the fact. The other point is this. This is a little bit different. So let me so here I did a couple of testers here on EU, Euro, USD, same lots, so I'm paying the same commission, same targets, as far as like pips I'm going for and stuff like that. But why is it two completely different? My closed P&L were completely different. Why? Slippage. You're not consistently getting the same win-ins or losses that you think that you're going to get. You might say, I want to risk 1%, so 1,000. I only lose 1,000 on every trade. You know what? If you lose that trade, yes, you've got commission on top of that, so you're not losing 1,000 anymore. You're losing 1,000 and something commission. But then, because the sell price is lower than your target, let's say you're doing a sellout for your stop loss is a sell, it doesn't sell out at that price. It has to go through that price before you can get it. And this is what, again, let's go back to TradingView. This is what a lot of people don't really get. Like if I come here and I say, right, I'm gonna put a sell here, right on this thing here, and in TradingView, look, it's tagged me in, right? It's tagged me in. TradingView's tagged me in. Well, actually, The realistic point is that in order to get into this trade, I need to target lower because of slippage. Because yes, the price might go up here on a sell side, but the buy price is much higher. So how am I getting in? And this is what these, it doesn't tell you this very obviously in TradingView or anything. It's just not there. So saying like, when you see these people and they go, oh, look, it just tagged me out. It's to the pip, man. No, fuck you. You're fucking lying. It's bullshit. In order to have been tagged into this trade, not only do I need to put the order in FXCM because the broker, I needed this specific price, right? And it's all calculated off this price on this broker. Not only that, but I would probably also need to have my entry here before I would even be tagged in. And if my entry is here and it went over, and this is where I'm really going to fuck with your head and you're going to turn the fucking video off, is that actually I need an arrow. Give me a fucking arrow. No, I'm going to do this. The fact is that even though I put mine here, right, and I get tagged in fact, actually, and here's the fucking kicker, my entry isn't here, it's down here. Fucking calculate that in your fucking brain, right? So often when you see your trades going through, you might think like, I wanted to get in there. Like, why does it put me in down here? Because now, if my trade is down here, it's not 1-to-1 anymore, is it? I'm not risking 1 to make 1. I'm actually risking 1.2, 1.2 or 1.1 to make 0.9. And it's all to do with slippage. And again, this is what people don't realize. You might put your entry here. It doesn't mean you're going to get that price. You might get lower or higher depending on whether you're buying or selling. So let's say I turn this around and I say, right, I wanted to buy on this. Then actually what happens is that as it comes up and I think, oh, thank goodness for that. It never tagged me in. It never tagged me in because it never got to that price. Well, your broker might be up fucking, with this price might have come up here. Because the price isn't the price you're getting from, FTMO or whatever broker you're using, because you're looking at FXCM. And the other thing as well, and this is the point, would I got tagged into this? Yeah, of course I would. 100% I would have been tagged into this trade. Now, why would I have been tagged into this trade? Slippage. It would have tagged me in. And actually, the crux of it would be that I would have been tagged in here. So I would have already been in a losing trade and I'd have done a loss. Then I would have paid commission and blah, 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 blah. So it's like, I'm throwing a lot here because it does make me fucking angry. But this is why, like you have to understand there is a lot of things happening here that, you need to understand. It's like the fucking fundamentals of trading. You need to understand how trading is going to fuck you in the ass, because it is going to fuck you in the ass. It is just a fucking nightmare. And, it's things like this, the slippage, the fucking difference in brokers, like none of the fucking funded, companies that do the funded accounts and stuff like FTMO, none of them are on TradingView, so you can never see their broker number, so you can't build a specific strategy around it. And I'm telling you, it's things like that make me say, I fucking hate trading.